Hello everyone, and happy Labor Day to those of you here in the U.S. As you know, our U.S. markets are closed today. I am back home in Southern California after a rather extended trip back. It was supposed to take about 14 hours, ended up taking about 32 hours. We had a flight cancellation, we had a change of initial airports, we had to take a cab an hour away, then that airport had a fire alarm go off. We had to evacuate the airport, and then we missed our flight. Once we finally got to Heathrow, had to get a new flight. Then that ended up being delayed, so it was a long trip home. And I largely slept in yesterday. So anyhow, we are back at it here on Monday morning. This is our equity curve. Continues to have a very nice shape to it. Again, I want to point out that this little leg right here was a favorable mistake. This was a mistake that happened in my favor. However, at this point, with the recent closing of our latest position that we did close this week for about an 11.5% profit, we should be making new highs even with that. So overall, this things are moving along nicely. This is the bar chart that shows each individual trade, the wins and losses on each of those trades. This is the list of each of those respective closed trades. This is the one that was just closed here this week. And so that's kind of where we're at this point. If we take a look at our open trades, I'll just pause here a second. Oh, there we go. We got that. So I will probably early this week be rolling our Google wheel strategy. So we've now sold this put. This is a second time we sold the put. We've taken in a decent amount of money, about $445 on that. And again, we're going to just keep rolling that naked put until such time that I get assigned on it. And then at the time I get assigned, then I start selling calls against it. And that's all part of the wheel strategy and lowering your cost basis in an equity position. Again, as we've discussed previously, you have to want to own 100 shares of Google and have the wherewithal to do so in order to be able to take advantage of this particular strategy. Then we have this trade that's cooking along well. There's an order out there to close one butterfly. I put this order out on Friday to close one butterfly at $2. If that were to fill, we would end up in strictly a vertical position like this, in which case I would decide what to do with that from there. Do I just close the vertical? Do I let it decay? Do I add a call vertical, turning it potentially into an iron condor? Those are all potential possibilities once the butterfly portion of this trade closes. So again, that butterfly portion, there was a GTC order that I put out on Friday on that one. Then this is a calendar. This is going to expire this week. So this is going to start to decay fairly quickly. And because this is an adjusted trade, we started off with an original calendar much further down here in the market. I want to say it was around 44.50 if my memory serves correctly. Then we added the second calendar, pulled the first one totally off, and ended up with just this one calendar. So as this starts to decay this week, I'll be pulling this off. But because it's had some adjustments, I'm going to be pulling it off a little bit faster. I do not want to end up having to deal with this thing late in the day on Thursday or even Friday, going into expiration of those short strikes. So that's what I'm hoping to be able to do here. We'll have to see how that plays out. This was a new position that was just added. This is just a broken wing butterfly. It expires out about 2 weeks, 2.5 weeks by the time the market opens tomorrow. So this will be helped by a little bit of a pullback in the market. I am anticipating September tends to be a historically volatile month. Many times there's been sizable drops that happen in September. We also are starting to get some economic news, things along those lines that seem to be making a little bit of a pullback more of a likely scenario. Again, you never know with the markets, but right now I'm leaning toward the fact that within the next week or two, we're probably a little more likely to have a pullback than we are another big run up. So again, just because I have odds on that, it may be 60%, 65% as a pullback, doesn't of course mean the market won't rip up. And then we have this particular trade on Apple. And this thing has been adjusted a number of times, so also here. I'm not going to try to squeak a lot out of this. I want to just try to get it to break even, maybe a small profit. And because Apple has run up so much, I will likely look at either closing out this put side or maybe even just rolling up this long put to reduce risk. I'll have to take a look at what those numbers look like here early this week, possibly on Tuesday when the market opens back up, or maybe Wednesday. So we'll have to, I'll kind of look at potential game plans on that one. So that is where we're at on our open positions. Of course, we did close this. Let me move my smiling face out of the way here. We did close this position for the $238 or 11.5%. And then, of course, these are the remaining positions that are open that we just walked through. So if we take a look at our markets at this point, we had sold off a fair amount. I mean, that's a fairly sizable sell-off that happened a few weeks ago from the 4,600 range down to just shy of 4,300. So that's a 300 point pullback, so about 7%, somewhere in that general range. And then, of course, we've had a few hard rallying days. We've gotten back up into an area that might be considered some resistance. And my expectation here is probably a bit of a sideways chop, and then ultimately a little bit of a pullback, probably back down into this area here where you had prior resistance, and then we broke through that resistance, and that had become support. Then it was resistance again, and then it broke through on this big up day. I would maybe expect realistically by the end of this week a pullback back into that 44.50 range. That wouldn't surprise me at all. So if we do start to get that pullback, volatility will likely rise, and that would be an opportunity for us to potentially thin out or take off some of the existing trades, and of course add some new ones in a higher volatility environment, which is a more favorable environment, gives you better reward to risk ratios when you're putting on butterflies. As those of you that have taken the deep dive butterfly class get all the explanation on that and why that is and how it happens and how to the best scenarios for putting on new butterflies, etc. So anyhow, that is my market expectation here at this point. And again, I like to just put odds on things. I don't like to go into anything with definitive, the market's going to go up, the market's going to go down. Just always put odds on it and build your trades under those assumptions, and then they can be adjusted as you need. And I guess that's it here for today on Labor Day. So thank you so much, everyone. I'll be back in Southern California here for a little while. Might take a road trip toward the latter end of this month, but that won't affect me much from an internet standpoint because obviously we have pretty stable internet here across the country. So that's it for now. Anyone has any questions, please post them below. Also, make sure you like and subscribe if you like this sort of content. And I thank you very much. Take care.